So, I've saved up for a long time and I want to know if I can retire. Well, let's talk about that. So, I see this all the time when I'm online. People will ask a question and it says something like, I've been saving up for a long time. Can I retire? Well, there actually is an answer to that, and it's the same answer I gave my advisory clients back before I retired, and that was, it depends. There are some things that we have to do to figure this out. Now, the good news, though, is it's all about numbers. And I know that a lot of people are worried about numbers and sometimes scared about numbers, and that's okay. What I love about numbers, though, is that they don't lie. And so the process that we're going to go through right now is really going to help you decide and figure out whether you can retire or how long it will take you to retire. And there are a couple of other moving parts as well. So let's go through this. Now, here is my answer to that question. Can I retire? All right. First of all, there's the income. How much do you have right now in your retirement accounts? And I'm not talking about money to pay bills. I'm talking about specifically set aside for retirement. So there might be 401ks, IRAs, regular IRAs, Roth IRAs, money put elsewhere for retirement. So total that up between your whole household, yourself, if you're married, yourself, and your spouse. How much are you contributing monthly? And the funny thing is, I asked this question quite a bit. How much are you contributing monthly? And people didn't really know. So where we would go to find that out, if they're still working, is their pay slips, their 401k pay slips. And then we would just figure it out, and it might be, let's say, $300 a month. So we would use that then. Then, how many years before you want to retire? 20, 10, 5, 1, tomorrow? So we have to know that. When do you want to be able to retire? Then we're going to add those numbers up, and we're going to use what's called the 4% rule. And this is the standard industry rule, not my rule. It's just the way everyone does this. I would say that 4% should be your maximum. So if you can make this the 2% rule or the 3% rule, that's fine. But we'll call it the 4% rule for now. Then, how much is your Social Security going to be? What are your benefits going to be? You can start it as early as 62. Your full retirement age is 66, and then you can wait until 70 if you want to do that. If you want to find out how much your Social Security benefits would be, let's say you're 63, and you want us to start today, go to socialsecurity.gov, just sign in, create an account, go to that calculator, Social Security Benefit Estimator, and they'll tell you. Okay, they'll tell you exactly that figure. And again, if you're married, you want to do the same thing for your spouse. Do you have pensions that you're expecting? You got to figure out how much those are. Do you have rentals? Do you have any other kind of income that you're going to be able to carry into retirement? And then we're just going to add them up. And by the way, when we're calculating your 4% rule, I'll show you how to do that here in a minute. Okay, so that is going to be your income, and that's only half the story. What I never see people bring up is the fact that they have outgo as well. So we have to think about that. What is your monthly budget in retirement? If you want to, make 2 or 3 budgets. Call one your dream budget, call one your minimum budget. That's fine. You know, be as flexible as you would like. And while you're doing this, think about when your home is going to be paid off. If you're 63 and you have another 7 years of mortgage payments, we have to figure that into your monthly budget. But the good news there is, after that 7 years, your house will be paid off and your budget's going to change for the better. Then you're going to add up all of those things, all of your outgo, your monthly budget in retirement. So now we have your income and we have your outgo. Now, I talked about the 4% rule, and I want to get into that because this is very important. In fact, it might be the centerpiece of your entire plan here. People always ask, well, how much can I take out without worrying about running out of money? It's our biggest fear in retirement. Am I going to outlive my money? We don't want to do that. That's where the 4% rule came in. It says that when you retire, you're going to take your nest egg. To keep it simple, let's say it's $1 million. You're going to invest that or have it invested for you, and that's not what I do anymore, but you will have it invested for you that anticipates maybe a 5% long-term return. That is less than being in the stock market all the way. It's not as risky as being in the stock market all the way, but that's what you want to do. Okay, so that money is going to be set aside. Then you're going to take out, looking at that first $1 million figure, 4% annually, with maybe 2 or 3% annual increases. So you're going to start then, off of that $1 million, you're going to start at $40,000 a year, or 4% of $1 million. Now, if you think about it, that means then that not only is your nest egg not shrinking, but if you're making 5%, for example, a year, that means your nest egg is actually increasing. And if you have kids, you're leaving a legacy for your kids. Now, of course, you can always dip into it as well because it's your money and you earned it. But the good news is it's almost like a life insurance policy. It's going to be good for your spouse if you pass away first, and then it's going to be good for your kids when you're both gone. Okay? Now, if you want to calculate what your nest egg is going to be, let's say in a year or 2 or 3 or 10 or 20, go to investor.gov, go to their calculators, and you go to the compound interest calculator. This is what it looks like. It has your initial investment, it has your monthly contribution, your length of time in years, your estimated interest rate, like I said. So if you're getting close to retirement, I mean, you don't want to put a lot of money at risk. So maybe 3% might be a better number to put in there for now. The interest rate variance range, I always put 0. And then your compound frequency is going to be annual. What it's going to look like then, if you look on the bottom here, it says, for example, in this one, I had $500,000, $500 monthly contribution, 3% estimated interest rate, and compounded annually. I calculated it out. It says $611,000. Now, if you multiply that by 4%, based on that, you're going to make about $24,000 a year, roughly $2,000 a month. I hope that makes sense. Of course, you can always, pause and go back, but it's as simple as that. So then what we're going to do is add that to all of your other income. Again, your Social Security and everything else. So here it is. We're going to take that nest egg income using the 4% rule, your total household Social Security income, and your total other income. And that might be pensions or, rental properties, whatever else that you have. That's going to give us a total. But we got to talk about the outgo. It's just as important. So the outgo is going to be your retirement budget. So again, if you want to make 1 or 2 or 3, you want to have some kind of idea of what your budget is going to be every month in retirement, because your income is only half the story. Then you're going to add in income taxes or subtract income taxes. And that might be 10%, 15%, whatever you think is prudent, depending on the level of your income. For most people, 10% is usually a good way to go. I always throw in a 10% contingency for the unexpected. You can't forget things like health insurance, other kinds of household costs, life insurance, whatever it is that you're doing. Make sure it is in your budget. Then you're going to add that up. Simply put, you're just going to compare your income to your outgo. Then you're going to have to make the decision whether you can retire now or in 3 or 5 or 10 years. If the numbers don't look good, what can you do about it? Well, what you can do is you can contribute more monthly, for example, so we can get that retirement nest egg higher. Theoretically, you could put your money at more risk. I'm not a big fan of that idea, but at least when you look at this, you compare those two numbers, you're going to be able to see where you are in terms of your retirement. That's just called the retirement income planning process. So look at the numbers, decide how close you are. If you're not ready, then calculate when you will be. Maybe instead of a year, it might be 5 years. Instead of 7 years, it might be 10 years. Or instead of 10 years, it might be 2 years. You don't know. I've had many times when people started adding up in their Social Security and other income, they were shocked at what good shape they were in, and they were able to retire earlier than they were thinking. So this is not necessarily some kind of a negative process. So income and outgo, that's it. That's the retirement income planning process. Thanks. We'll see you next time.